Interest as a concept dates back to invention of wheel. It is a hidden fee attached to every financial decision. Choosing to spend today instead of saving, one may miss out on potential interest earned, that is the opportunity cost. While investing in project, businesses will compare expected return or internal return rate to the prevailing interest rate. If IRR is more, then the investment is attractive. Risky investment offer higher potential return to compensate for higher opportunity cost one takes by giving up safer low interest options. WACC is the weighted average cost of capital, which represents the average cost of all companies' debt and equity as per their proportion. This cost include risk-free rate, often represented by government bond yield, and risk premium reflecting the company's specific risk. Declining interest rate reduces the cost of debt for companies, making it cheaper to borrow money, lowering WACC, which is used to discount future cash flow to present day by dividing the component 1 plus r to the power n, where r is the WACC and n is the number of years. Smaller r means smaller denominator, which increases present value of cash flows, hence the valuation increase. As interest rate decline, investors may seek higher return by investing in riskier assets such as stocks, which can drive up potential stock prices and valuation. The overall increase in investor demand for equities can contribute to higher valuation for companies regardless of their specific fundamentals. Central bank through its tools like reserve ratio create multiplier effect, increasing money supply in the economy by lowering reserve ratio. They can buy The central bank can buy government bond to inject money in economy. Inflation is also controlled by increasing interest rate, which could dampen consumer spending, investment, and borrowing. The disappearance of blockbuster IPOs and the struggle faced by tech startups can be linked to changes in monetary policy, inflation dynamics, and shift in investor sentiments, all of which impact business operation, financing cost, and market condition. Now we can apply this concept to what happened during pandemic. Expansionary monetary policy was followed by central banks by lowering interest rate, making it easier to borrow money, resulting in increased money supply. This was reinforced by aligning fiscal or federal policy through which government spending was increased. There was tax cuts to incentivize investments. The low interest rate environment during the pandemic fueled a surge in investment in tech startups, leading to a boom in funding, hiring, and valuation. However, as interest rate began to rise, cost of borrowing increased, prompting a shift in investor sentiments and resulting in layoffs and financial strains for overvalued companies. Tech startups, especially those with high valuation, heavy reliance on external funding, may be particularly vulnerable to shift in investor sentiment, interest rate, and economic conditions. The combination of rising interest rate, inflationary pressures, and increased scrutiny for the business fundamentals may have contributed to challenges faced by tech companies, leading to layoff, distressed sales, and potential bankruptcies. However, we must remember, like life, economy, and business cycles are also like cyclic in nature. Just before the sun rises, the sky is at its blackest. Thank you.